What are support and resistance? Theoretically, these are the highs and lows of the market, where the price may reverse from. But how to find them? Suppose this is a 5-minute chart, and the price rejected downward 2 times from a similar price point. This is resistance, and there is a high probability the price will reject downward again. The same goes for supports too. If the price rejected upward 2 times from a similar price point, this will be the support. There is a high probability the price will reject upward again. Let's head to TradingView and mark some trades with support and resistance. Here we are in a USD JPY chart, and you can see the price rejected upward few times. To mark the zone, we need a rectangle, which can be found on the drawing panel. Rectangle help us to get a much clearer idea of our zones. The rectangle will be placed on the most common parts of the zone. I would recommend to mark this as favorite because you will need it much often. Let's play. As soon as the price reaches the support, I'd like to enter a trade. Stop loss will be placed below the zone. I always recommend the take profit to be twice the size of the stop loss. In this trade turned to be a profit. Let's look at another example. You can see the price rejected downward few times. Let's mark the resistance zone. If you are a beginner, it will take time to understand the placement of rectangle on the zones. As soon as the price reaches the resistance, I'd like to enter a short trade. This trade turned out to be a profit. You can also trade the market when the price breaks the support or resistance. Let's say you went long on a certain support, and unfortunately you got stopped out. But you can get on a short position right away if you get correct signal. If a market moves in between support and resistance, the market is said to be in a consolidation, or you can say the market is in a range. Most of the time the consolidation breaks and you have to get the best moment to get into a trade. This market is in a range. The price is rejecting from support and resistance for a long time, and at a certain point the range breaks. So, how would you get into a trade? You need a trigger. A trigger simply tells you when to get in, and sometime when to get out of a trade. For a trigger, you need a big candle in support of the particular break. If your consolidation breaks on the upside, you need a big green candle to be called as a trigger. Or if your consolidation breaks on the downside, you need a big red candle to be called as a trigger. Note, the trigger must be big, and it should not contain massive opposite wicks. Let's look at some live examples. This market is in a consolidation for a long time, means it may break at some point. The moment it breaks, we will have to notice a big candle on that direction. If there is a big candle during break, we enter a trade by keeping the stop loss just below the candle. And this trade ran in our favor. Let's look at another example. As you can say, this market is clearly in a consolidation. The moment it breaks, if you see a big candle supporting the move, you can get in by just risking the size of the candle. This trade also ran into a profit. All these entries are fine but not perfect. We need a pullback. For perfect entries during breakouts, you need to wait for the price to come to a supply or demand zone for a retest. Supply and demand video is coming up next. Subscribe for more.